How many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case.
Did you know putting your money in a savings account is not making you rich? It's making the banks rich. The bank uses the money in loans or investments and gives back a tiny percentage to the account holder. So why do so many people choose to give away all that extra money? The safety of a savings account might be the reason why you're afraid to start investing your own money, or you might have other reasons not to do it. My job by the end of this will be to show you why you need to start investing now and punch back all those doubts you have about it. Maybe you, like a lot of other people, are putting all your extra money in a savings account. You thought about investing it, but it's just too risky. I don't want to lose it all. What if there's a market crash? I think we're in a recession. I don't think now is a good time. It's too complicated for me. I don't understand it. I don't know where my money is going. Everything is so overpriced now. I wish I could have started investing 5 years ago. It was so easy back then. Trust me, I had all of those thoughts at one point or another. Turns out a lot of people do, and maybe you do too. Investing can be a scary thing, and it should be. Many people have lost a lot of money in the stock market. You can definitely, if you want to, invest your money like you're playing at the casino, except you don't have to. If your fear of investing is stopping you, making you wait in the sidelines like I did for so long when I started, no matter the reason, let's discuss investing and look at it through the eyes of famous and successful long-term investors, and let their words and their wisdom do the convincing for us. We started earlier by talking about savings accounts. If you have one, this relates to you directly, but even if you don't, there's a very important concept to understand here for everyone. Let me tell you something. Banks will be extremely happy if you choose to put all your extra money in one of their savings accounts. This is because ultimately, banks use the money people deposit in their accounts to make more money. You do get paid for putting your money in a savings account. Usually it's somewhere around 0.5% interest annually, but you can expect banks to get between 5 and 10% annual return on your money by investing it or using it for their commercial activities. They get the lion's share of the reward, and you get the scraps. Banks are incredible at making money with money. That's what they do. Savings accounts are one of the easiest ways they have to get access to a cheap loan. You see what's going on here? Whatever your reason for putting money in a savings account, lack of financial knowledge, choosing the easiest path, or simply the fear of losing money, the banks are taking advantage of it. Do you want your life savings to be used by those rich and powerful corporations to make them even richer and more powerful than they already are? By not investing your money in a proper investment account, you're not only losing out on a lot of extra money you could make, but you're giving away that extra money to those gigantic corporations, the banks. Just think about it. A small investment of time now to learn how to invest your own money will give you exponential gains in the future. That's more money for your retirement, more money for your travels, your hobbies, your family. That's more freedom. Moral of the story, savings accounts are better than nothing, but they're far from the best choice for your life savings. When is the best time to start investing? That's a very important question. When investing for the first time, you might be thinking, what if there's a recession? What if there's a market crash right after I start investing? What if I buy an overbought stock and it immediately crashes? There's a famous quote by Kenneth Fisher, an American billionaire investment analyst, saying,
"Time in the market beats timing the market."
Your greatest asset, your greatest advantage is not trying to find the best moment to start investing by predicting how the stock prices will go up and down. It's making sure you start investing as soon as possible. It's taking advantage of time, of long-term investments. Compound interest is a guaranteed money-making machine, but that machine feeds on time. And most people don't give it enough time to reap the rewards. If you're still in your 20s, for example, you have the best advantage of all. It's time. Start investing now and you will end up better than someone who waited a few years on the sidelines trying to find the best moment to get in. Let's look at some data to hit that point home. What if I told you it's nearly impossible to find a 10-year period where you would have invested in the S&P 500 and lost money? Don't believe me? Let's look at the data. So here in blue is the average yearly return from the S&P 500 since 1928, a few years after its creation in 1923. Knowing this index mostly represents the US economy, it's so interesting to see how much of a roller coaster it can be. You can see huge swings in momentum every few years. Then from 1928, we can start calculating the average return over a sliding period of 10 years, and we get this orange line, also called a 10-year moving average. There's a point here in 2008 which gets close to zero. Turns out this is the only moment in US history where you could have lost money investing in the S&P 500 for 10 years. But what we quickly understand is to be in that situation, you would have had to be the unluckiest investor of all time. Let me explain. The unluckiest investor of all time would have started investing in 1999. That year was a special moment in the US history. Not only was it at the turn of the millennium, going from the first millennium to the second, but it was also the height of the dot-com bubble. This is when the stock market got hyperinflated because of the excitement of people towards the latest technology, the internet. Everyone went crazy about all the companies that just mentioned the word internet. Move 10 years forward and our investor finds himself in 2008, the infamous housing crash where all the stocks fell by almost 40% in 1 year. So let's get this straight. Our very unfortunate investor would have bought everything he could in 1999 at the height of the dot-com bubble, and then sold everything at the end of 2008 after the stocks fell down nearly 40% because of the housing crash. This is the only moment you could have invested in the S&P 500 for 10 years and lost money in the entire history of the S&P 500 itself. This just speaks on how much the S&P 500 is a safe investment on the long term. Many people might be afraid of the stock market because it looks unpredictable, but the truth is, it becomes predictable for the patient investor. You might be feeling like investments are complicated, that you don't have the knowledge or don't want to get the knowledge to invest money on your own. Investing is not as straightforward as just putting your money in a savings account, but it can be almost the same. Investing can be as complicated or as simple as you want it to be, and that's the beauty of it. Usually, what leads people to losing money is not the technical part, it's the emotional part. As it was said by Benjamin Graham, Warren Buffett's mentor,
Mr. Market's job is to provide you with prices. Your job is to decide whether it is to your advantage to act on them. You do not have to trade with him just because he constantly begs you to.
Graham likes to refer to the stock market as Mr. Market. He considered the stock market to be like a person with bipolar disorder, sometimes very optimistic and sometimes very pessimistic, but most of the time very irrational. Peter Lynch, one of the most successful mutual fund managers in the world, said,
"You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready, you won't do well in the markets."
The stock market is not always going up, that's obvious. But it's not so obvious when you apply it to a single individual stock that you picked. When bad news about a company come out, it doesn't take much for the stock price to go down, for people to start panicking. When you see reports, articles left and right about how bad a company is because this or that number is lower than the Wall Street expectations, it's so easy to give in to the panic. But let me reassure you, there are many ways to avoid panic selling. If you have more time, really think about which company you want to invest in. Find out which companies you trust and believe in. Really look at what they're doing now and how well they will be doing 10 years from now. Then invest in those companies. And if you did your job well, when comes the time of a market downturn, and there will be one, you won't panic sell because you trust this company. A market downturn now is not a moment of panic. It's an opportunity to buy the best companies at a cheap price. Just like Warren Buffett said,
"Be fearful when others are greedy, and be greedy when others are fearful."
Another way of avoiding the roller coaster of emotions from the stock market is simply to ignore it. There's a very practical way to go about that. Anyone can do it, and it's one of the most proven and effective strategies out there. But there's one disadvantage. It's boring and it takes time, which is why so many people don't like it. I'm talking about dollar cost averaging. This could be the topic for a whole other video, but here's what it's about. Dollar cost averaging basically means investing equal amounts of money at regular intervals. And here's the best part, regardless of the price of a security. You heard it right, regardless of the price of a security. But careful here, it doesn't mean just close your eyes and buy whatever stock you find first. It's more find an investment you like, that you understand very well, and keep buying it consistently, always with the same amount of money. Most people use the DCA method with index funds or ETFs. Our friend Benjamin Graham said,
The ideal way to dollar cost average is into a portfolio of index funds, which own every stock or bond worth having. That way, you renounce not only the guessing game of where the market is going, but which sectors of the market and which particular stocks or bonds within them will do the best.
investing used to be very different than it is today. Jesse Livermore is the most famous day trader in the history of the United States. But he lived more than 100 years ago, when there were no computers for trading, no regulations for financial statements, little to no oversight on the stock market. But he still managed to make a fortune. Jesse Livermore wasn't afraid. Today, investing your money is easier than ever. Stockbrokers have apps. You can literally invest anywhere, anytime. If people like Jesse Livermore were able to make it work 100 years ago with barely anything, you can too. Not only are the tools infinitely better than they were before, financial education is also becoming easier and easier to access online for free. So stop finding excuses and get on with it. If you enjoyed today's topic and want to learn more about investing in personal finance, consider liking this video and subscribing to my channel. More amazing content to come like this one.